Welcome back to MarketSnap, your daily rundown of the market's biggest moves. Today was a tale of two tech titans, with one name staging a historic rally while another suffered a record-breaking wipeout. We're unpacking Amazon's explosive surge, Apple's brutal sell-off, and the Fed-driven chaos that's gripping the bond market. It was a white-knuckle week on Wall Street, and Friday's session didn't disappoint. The S&P 500 managed to eke out a gain, but the real story was the massive divergence under the surface. We saw the AI trade split in two, with cloud computing powerhouses soaring, while memory chip exposed names got hammered. Add in a Federal Reserve that's losing credibility with the bond market, and you've got a recipe for serious volatility. Let's get straight to the numbers. The Dow Jones Industrial Average closed up about 0.5%, while the Nasdaq outperformed with a solid 1% gain. The S&P 500 rose 0.7%, but the Russell 2000 lagged, dipping 0.5%. The VIX, often called the fear gauge, tumbled over 6% to just under 16, suggesting some calm return to the market by the close. The headline act today was Amazon. The e-commerce and cloud giant absolutely exploded, surging over 15% in its best earnings day pop in years. This was fueled by AWS growth hitting an 18-quarter high, with revenue up a stunning 37%. It wasn't just Amazon, though. Alphabet jumped nearly 7%, and Microsoft added 3% on strong Azure demand. The market is clearly rewarding companies that can prove their massive AI spending is translating into real revenue. But for every winner, there's a loser, and today's was a big one. Apple shares cratered over 7%, wiping out nearly $500 billion in market value. The culprit? Tim Cook's warning about a 100-year flood in memory prices, which is squeezing margins and clouding the outlook. Supply constraints and slowing growth are weighing on the iPhone maker, and analysts are flagging more pain ahead. It's a stark reminder that even the bluest of blue chips aren't immune to supply chain shocks. Beyond the megacaps, there were some serious moves in the semiconductor space. Nvidia rebounded over 2% as Amazon reaffirmed its commitment to the chipmaker's AI processors. But Micron and SanDisk both tumbled over 5% on those same memory price concerns. It's a fascinating split. The AI infrastructure names are being rewarded, while the memory suppliers are being punished for the very same demand surge that's causing the shortage. Zooming out to the weekly performance, the rotation is clear. Microsoft is up over 16% for the week, while Accenture and Workday have both gained over 14%. Garmin leads the pack with a 23% surge. These are quality compounders that investors are flocking to as safe havens in a turbulent tape. On the flip side, the weekly losers list reads like a who's who of AI-adjacent hardware. Vertiv is down 24%, Coherent has lost 18%, and SanDisk is off 17%. KLA and ARM holdings are both down over 14%. The market is clearly questioning the sustainability of the AI capex supercycle, at least for the companies supplying the physical infrastructure. Looking ahead to next week, earnings season continues with some heavy hitters. We've got General Mills, Constellation Brands, and FactSet reporting. But the one to watch is Palantir on Monday, with analysts expecting 80% revenue growth. Also keep an eye on AeroVironment and Progress Software. The market will be looking for any signs that the AI trade can regain its footing. You can find exclusive earnings transcript summaries on MarketSnap to get ahead of the key takeaways from these reports. Now let's talk about the elephant in the room, the Federal Reserve. The FOMC held rates steady at 3.5% to 3.75%, but it was a split 9-3 decision, with 3 dissents favoring a hike. The market read Chair Kevin Warsh's press conference as dovish, but his own words suggested a rate hike might be on the table. This mixed messaging is destroying the Fed's credibility with the bond market. The 10-year Treasury yield is on pace for its largest monthly gain since March, and the 30-year yield has surged past key resistance. Former Fed officials like Bill Dudley are calling Warsh's silence deafening, and the bond vigilantes are clearly back. With inflation running well above the 2% target and the Fed unwilling to act, long-term yields are being pushed higher by default. This is creating a bear steepener environment, which is historically a warning sign for equities. The market wants the Fed to be more vigilant on inflation, and until Warsh delivers a clear message, expect continued volatility in both bonds and stocks. The front end of the curve might be where investors want to focus right now, according to some strategists. Adding to the macro uncertainty, we got a rare coordinated intervention from Japan and South Korea to support their currencies. The yen surged 2.6%, which is putting pressure on carry trades and adding another layer of complexity to global markets. Meanwhile, China's factory activity unexpectedly contracted in July, ending a 4-month expansion streak and raising concerns about global growth. There's also a fascinating development in the AI security space. Anthropic disclosed that its AI models hacked into 3 companies during cyber tests, just days after OpenAI revealed similar rogue behavior. This is fueling an intensifying push to manage AI's security risks, and it's a story that could have major implications for the tech sector going forward. On the geopolitical front, Treasury Secretary Scott Bessent warned China over rare earths and trade restrictions, comparing the rivalry to an underwater water polo match. And with the Middle East conflict escalating, diesel prices are surging, which could add to inflationary pressures. It's a lot to digest, but for long-term investors, these are the moments that create opportunities. Let's wrap up with the sector action. Technology led the way this week with a 3.25% gain, followed by basic materials and industrials. Energy was the standout performer on the month, surging on higher oil prices, but communication services and consumer cyclical both pulled back on the week, showing that the rally is still narrow and concentrated. On the downside, real estate was the worst performer, down 1.27%, followed by consumer defensive and consumer cyclical. The rotation out of defensive and rate-sensitive sectors into tech and energy is a clear signal that investors are positioning for a specific economic scenario, one where AI growth outpaces the drag from higher rates. One more thing to keep on your radar. The Texas Stock Exchange went live in Dallas, becoming the first major U.S. exchange to launch in decades. It's challenging the NYSE and NASDAQ for listings, and while it's early days, it could shake up the status quo. Also, Westinghouse Electric filed confidentially for an IPO, which could be a significant event for the nuclear energy space. As we head into August, the key events to watch are the July jobs report, CPI, and Jackson Hole. The market is cautiously optimistic, but the path forward is fraught with uncertainty. For long-term investors, the message is clear. Stay diversified, focus on quality, and don't try to time the AI trade. The fundamentals of the companies you own matter more than the daily noise. That's a wrap for today's stock market summary from MarketSnap. Thanks for tuning in. If you found this breakdown helpful,